Ask 10 different investors what the best ETF is, and you'll get 10 different answers. Some will tell you, just buy VOO. Others swear by QQQ. It's outperformed everything. And the dividend crowd? They'll tell you, SCHD is all you'll ever need. Everyone's got a favorite, and everyone's got a reason for it. So who's actually right? Here's the real question. If you had to put every dollar you own into just one ETF, which one gives you the best shot at real wealth over the next 20 years? At first, the answer seems obvious. Just pick whichever one has the best historical return, right? Not so fast. Investing isn't about picking the ETF that made the most money yesterday. It's about picking the one you'll still be holding through the next recession, the next crash, maybe even the next financial crisis. So today we're putting 3 of the most popular ETFs on the planet. Head to head. VOO, QQQ, SCHD. Their returns, their risk, their dividends. Where each one actually falls apart, and most importantly, which one I'd actually put my own money into, if I could only pick one. Fair warning, though. The winner isn't as obvious as you'd think. Stick around till the end. 3 ETFs. 3 completely different philosophies. Here's something most investors skip right past. These 3 ETFs aren't even trying to do the same job. It sounds obvious once you hear it, but almost nobody actually thinks about it this way. Comparing them purely on returns is like comparing a Ferrari, a pickup truck, and an SUV. All great vehicles, just built for completely different jobs. Same thing's happening here. Let's start with VOO. It tracks the S&P 500, 500 of the biggest companies in America. When you buy VOO, you're not trying to guess the next winning stock. You're betting on American business as a whole. Companies that have already survived recessions, inflation, wars, and a few technology revolutions along the way. It's simple, diversified, cheap to hold, which is exactly why millions of investors treat it as the base layer of a long-term portfolio. Now, QQQ, completely different personality. It doesn't own the whole market. It concentrates on innovation. Tech, AI, cloud computing, software, semiconductors. When those industries are hot, QQQ can put up numbers no other ETF on this list can touch. But concentration cuts both ways. The same bet that fuels the upside also makes it a lot more volatile when things turn. Basically, QQQ is asking you one question. Do you believe innovation keeps leading the market for the next 20 years? And then there's SCHD. SCHD isn't chasing the fastest growing companies, and it's not trying to own everything either. Instead, it hunts for profitable businesses with strong balance sheets, healthy cash flow, and a long track record of paying dividends. It's not built to impress you with explosive growth. It's built to reward patience. A lot of SCHD investors aren't just watching a number go up. They're getting paid while they wait. That's the real difference. 3 ETFs, 3 completely different philosophies, which means which ETF is the best might be the wrong question entirely. A better question, which ETF is best for you? Because before we get into performance, there's something more important we need to sort out. An ETF producing the highest return doesn't automatically make it the best investment. And that's exactly where most people get this decision wrong. Performance is only half the story. Okay, let's actually answer the question everyone came here for. Which ETF made investors the most money? If we're only looking at historical returns, QQQ probably wins. Over the last 2 decades, the companies driving the tech boom, Apple, Microsoft, Amazon, Nvidia, delivered growth nothing else could match. Anyone who stayed invested through that stretch made out extremely well. So at first glance, this conversation feels over. Higher returns, case closed. Except investing isn't that simple. A chart only shows you where an investment ended up. It doesn't show you what it actually felt like to own it. Picture 2 investors, same starting amount. One buys VOO, the other buys QQQ. 5 years in, QQQ's ahead. 10 years in, still ahead. Everything looks perfect. Then the market cracks. Tech falls a lot harder than the broader market. Every headline says the boom is over. Their portfolio's down more than their neighbors. Now ask yourself, do you keep buying every month, or does fear talk you into selling? That's the moment investing stops being math and becomes psychology. Returns don't build wealth, behavior does. Historical performance can be misleading that way. It tells you what happened. It doesn't tell you how hard it was to sit through it. Now look at VOO through that same lens. It never delivered QQQ's explosive growth, but it's quietly done something pretty remarkable. For decades, it's captured the growth of America's biggest businesses without leaning on any one industry. If tech slows down, healthcare might pick up the slack. If healthcare struggles, financials might carry it. It's built on balance. SCHD's a different story again. It was never trying to win the performance race. Its whole job is to own profitable companies, generate growing dividends, and reward the patient investor. Some years it trails the market, but in the years markets get shaky, it tends to hold up a lot better than people expect. Quick pause. If you're finding this breakdown useful and you want more videos that cut through the investing hype, go ahead and subscribe. Every week we break down ETFs, strategies, and long-term wealth building, one decision at a time. Now, there's one thing that matters even more than returns. Every investor loves making money. Very few actually know how much pain they can stomach to get there. No, it's not about the math anymore. It's about whether you can actually live through the ride. That's what we're testing next. The crash test. Let's put these three through a test that matters a lot more than performance. Bull markets make everyone look like a genius. Bear markets tell you who actually stays invested. Rewind to 2000. Not the most fun trip down memory lane, but stick with me. The dot-com bubble bursts. Tech stocks collapse. Some companies vanish completely. Others lose over 80% of their value. If you were heavily in tech, those years weren't just expensive. They were exhausting. A lot of investors just gave up. Fast forward to 2008. The global financial crisis. Banks failed. Housing collapsed. The market fell hard, and fear spread everywhere. For a while, it genuinely felt like the whole system might not hold. Again, millions sold near the bottom, convinced it would never come back. Then, 2020. A global pandemic hits. Businesses shut down overnight. It's the fastest crash in modern history. Barely 2 years after that, 2022 shows up. High inflation, rising rates, tech getting hammered all over again. Here's the part that actually matters, though. Every one of these ETFs survived. VOO survived. QQQ survived. SCHD survived. Every single one eventually recovered. Why? Because none of them were built around one company. They're built around businesses. Businesses that adapt, innovate, recover, keep growing. That's the real lesson here. Crashes don't kill great investments. They expose weak investors. The biggest risk in investing was never volatility. It's abandoning your plan halfway through. Think about the people who bought QQQ right after the dot-com crash. A lot of them doubled or tripled their money in the years after. But only the ones who stayed in. Or the people who kept buying VOO in 2008. At the time, it felt like the world was ending. Today, those purchases look like some of the best decisions they ever made. And SCHD? Its focus was never explosive growth, but a portfolio of profitable, dividend-paying companies gave people something just as valuable. The confidence to keep investing even when things got uncomfortable. And that kind of confidence is worth more than people give it credit for. Which brings us to the biggest question of this entire video. Knowing all of that, the returns, the crashes, the psychology, which ETF would I actually choose if I could only own one? Let's get into it. So, which ETF would I actually choose? We've covered the returns, the crashes, the psychology. Now it's time to actually answer the question that got you here. If I could only own one ETF for the next 20 years, which one would it be? Before I answer, one thing worth saying. This isn't the best ETF because there isn't one. There's only the ETF that's best for your goals. Chasing growth? Your answer's probably QQQ. Want a growing stream of dividend income? SCHD. Both are genuinely great picks. Either one could be the right call depending on what you're optimizing for. But if someone told me you can never buy another ETF again, I'd pick VOO. Not because it's the most exciting choice, not because it has the best track record, not even because it's the safest option on this list. One word: balance. VOO gives me exposure to the companies that have actually shaped the modern economy: tech, healthcare, financials, consumer brands, industrials, energy, communications. It doesn't ride on one trend. It shifts as the economy shifts. That's not a small thing. Most portfolios don't have that built in. 20 years ago, Apple wasn't the giant it is now. Nvidia wasn't leading any AI revolution. Tesla wasn't even in the index yet. The S&P 500 evolves. New leaders enter, old ones lose relevance and drop out. That's one of the biggest advantages of owning VOO. You don't have to guess who wins next. The market makes that call for you. That's genuinely powerful because predicting tomorrow's biggest company is nearly impossible. Owning whichever companies become tomorrow's leaders is a lot easier. Now, does that guarantee VOO beats QQQ over the next 20 years? Nobody knows. Could SCHD end up with better risk-adjusted returns? Sure, absolutely. Could some ETF that doesn't even exist yet become the next big thing? Of course, the future's uncertain, and that's exactly why I like VOO. It's not asking me to predict the future. It's just asking me to believe great businesses keep creating value over time. That's a bet I'm perfectly comfortable making. More importantly, it's the one I know I'd actually keep buying. Month after month, year after year, even when markets get ugly. And that, to me, is where VOO stands out. Not because it's perfect, because it's simple, reliable, diversified, and genuinely hard to outperform consistently over long stretches of time. Sometimes the smartest investment is also the simplest one. So who actually wins? Chasing maximum growth? QQQ's hard to ignore. Building a dividend-focused portfolio? SCHD's outstanding. Looking for the best balance of growth, diversification, simplicity, and long-term confidence? My pick is VOO. But here's what I actually hope you take from this video. The goal was never finding the perfect ETF. It's finding one you'll still own 20 years from now. Investing isn't about making one brilliant decision, it's about making one good decision and giving it enough time to actually work. In the next video, we're answering a question I get asked constantly. Honestly, it's one of the most common comments on this channel. How much do you actually need to invest each month to become a millionaire? The answer's probably a lot more achievable than you think. So if you don't want to miss it, make sure you're subscribed. And remember, a little wealth, built consistently, can become financial freedom.